Good evening, everyone. Welcome to the webinar. I'm Shreya. I'll be your moderator for the evening. Make sure to have your microphones turned off so there's no distractions. Throughout the event, I'm sure many of you will have lots of questions, so please drop them in the chat box. I'll be monitoring that and I'll be dropping in questions in between, or we'll definitely try to get to all of them at the end of the webinar. And if you have any difficulties, go ahead and message me as well.
Okay, thank you, Shreya. In interest of the time, I welcome David as well from General Index because we want to talk both the fundamentals sort of analysis plus the pricing analysis. They go hand in hand. And yes, the spotlight is on the oil, but I believe a lot of what we are going to talk is going to relatable to the other commodities as well. What we're going to talk is, I asked the question, challenges and opportunities to AI, what challenges and opportunities, and I'll share those answers. And yes, those answers were very run-of-the-mill answers, but I also want to share how we need to do some different thinking there, and we need to really think from experience rather than, and I believe that there is a lot more experience to be shared here. Then we will talk about some examples. I'm taking example from OPEC, I'm taking example from Russia, and try to do an analysis and tell a story. But the idea is to bring out how we can improve the analysis side and how we can convert the challenges into the opportunities. And then David will take some pricing angles and we'll talk about the Russian diesel and the SAF market, what kind of price analysis challenges are there. The whole idea is that this webinar stimulates some interesting conversation afterwards, and this webinar provides opportunities to engage with the ex-analysts. So this is the question I asked ChatGPT, and what I really found was that, as you can see, data quality came as kind of one answer, volatility, complexity, those kind of questions ChatGPT throw, climate, weather, information. I was surprised to see the talent and the tool come last. But a lot of these sort of challenges put by ChatGPT are probably out of control of the analyst, right? So it's not something which is in control. So in that sense, my goal would be focused on those kind of challenges which we can control and which we can do something about it. I asked the same question later on to Grok as well and found the answers to be quite similar. Policy uncertainties, supply chain issues, complexities, grid challenges, demand modeling, data difficulties. So I believe that these challenges are not new. If ChatGPT was there in, let's say, 10 years or 20 years ago, I believe that the answer would have been the same even then. So I think the real deal for today is to really talk about from experience what those challenges are really. I also asked those opportunities, and I think one key thing in these opportunities, what I found very useful and I really relate to, is the cross commodity analysis, because now as the energy transition is accelerating, the commodities are going in different directions, and those different directions are actually leading to a situation where no one commodity analysis can be performed in an isolation. So let's kick off with an example, Russia refinery strikes. And I'll use this example to showcase how this question is very complex. Is it a big deal? Is it really a hype? Or is it something, looks big, but actually is not making a market impact? And the whole idea is that to shift the news, the noise, and find out what exactly is the question. The most important market question in my mind is whether the diesel exports from Russia will come back. In the winter times, as you can see on this seasonal chart, typically December, November are the month when the diesel exports climb. Yes, the numbers are smaller compared to the last year, but these are not really bad numbers or very low numbers as it is possible to think because of these attacks. So this clearly tells me, yes, attack is having an impact, but not really possibly a big impact so far. And let's now look into some more data. So when I looked at this question, I tried to understand all the 40 plus refineries in Russia. And as you can see from the map, probably I need to do a more geographical analysis than anything else. And the refineries which are on the striking range are somewhere around 1,000 kilometers or maybe few 2,000 kilometers. And our view is that maybe the refineries which are far away, and these are big refineries which are far away, probably those refineries are running at a higher utilization compared to the ones which are struck. And some of the refineries have been struck many times. As you can see, it was very hard to find out actually the number of refineries. It was very hard to find out, even the capacity data is not visible easily, how many refineries are targeted, how many refineries are damaged. And I think the answer I found was that there is more hype in terms of the target, but the real damages probably were reported not low. And one big reason which I'm reading is probably because the drones, these are not missiles. Let's not forget that these are drones which have small payloads, and Russia probably is recovering and attending to these refineries faster than anybody else. So lots of data inconsistencies. And I think the key point is that we need to ask a lot of questions around these numbers and look geographical analysis, look maybe some technical analysis. What I also read was, for example, a lot of refineries are postponing their TAs, and some of the refineries which are hit, and then some of the refineries which are postponing their TAs are running harder. Again, let's look at some numbers. Russian product exports are indeed down, but if you look at compared to 2024, these attacks have been for a long time. I don't see the numbers are significantly higher. The scale of the chart clearly tells that compared to 2024, yes, October is a low month. Is this because of some seasonality considerations or other things? But soon you will find out that it is the clean product exports which is actually down. But what Russia is actually doing is pushing more dirty products sort of out. So it's not that refineries are fully affected. Maybe there is some change in how the refineries are being operated, which is telling that there is sort of a divergence between the clean and the dirty products. There is some fuel shortage in Russia, so maybe there is refineries being operated in a way that only clean products are cutting down, whereas the heavy ends are going out. If you look at the crude side, I also see because of the sanctions, Russia probably started exporting a lot more crude. If you see the 2025 line, clearly this shows that seasonally, based on arrivals, this is the time when the crude exports should fall, and the crude exports have actually gone up because probably before sanctions came, Russia wanted to send a lot more barrels into the Chinese sort of the storage or Indian storage. So in that sense, it may not be a case where refineries are running, are impacted, and that's why it may be a case that they just wanted to export more crude at this point of the year. Now, if you look at total crude plus exports compared to 2024, the data tells me that we are almost like quite a high level, 2019 levels. So this tells me, yes, there is impact, but probably I would conclude there has not been a huge impact on the Russian infrastructure, in my view, from these trade flow data. Similar way, let's look at the OPEC side of the analysis. I think I have been saying since March 2024 in my previous job as well, that OPEC is running with two pedals, and this took a lot of time for market to fully calibrate and understand. This chart shows the crude exports from the OPEC 8 members. So you can clearly see that the crude exports were down, but recently they started bringing up the crude exports up. And if you clearly look at the product side, the red line, which is the 2025 line, is the highest line compared to all those years. So the key point is that they have really calibrated and pumped up the product exports. And now as crude is being bought back, the products are going down. So there is a lot of noise around market share, price war that kind of happens. I don't subscribe to that. This is just calibration of the market. And that's why we don't see huge price moves, because OPEC is using these two pedals. Now I'll shift gears that probably, if you look at some more data points, these are the challenges in my view, and I will not be able to go into all those challenges. These are some stimulating thoughts from, I would say, long years of experience. First one, I want to point out there has to be a higher orientation towards a dollar analysis. Yes, we can analyze the OPEC flows, but to me, the more important is to make a call on time spreads, to make a call on differentials, to make more pricing calls rather than flow calls. A lot of analysis gets written which talks about the flows and the barrel side, but I think more analysis needs to happen on the dollar side. Same way, I would say there is a time value of insights, and there is a fear of being wrong or being out of consensus. Even if I know a lot of analysts are able to get to really good insights, they take a longer time to bring to the market. And I think the key idea is you don't have to be fast, but you have to be fast from others in the market. And for example, this whole crude versus products of OPEC, we started talking in March of 2024, whereas this became known and a talk of everybody else in the news, in the media, almost maybe 7-8 months later. So the real deal is to really get out fast rather than waiting for the fear of being wrong. I also feel that there is so much pressure on analysts to try to forecast what's really happening. Sometimes I believe that instead of forecasting what's really happening, we should forecast what EIA, OPEC, and IEA are going to print, the numbers, because these are the numbers that the market is moved by. So who knows what the real US shale number is? Who knows what? But the market moves by these reports. So I think we need to focus sometimes on not just forecasting the end state of the market, but the trajectories. And if you look at the evolution of the data of EIA, OPEC, and IEA, even if their absolute numbers look in different directions, the trajectories sometimes are in sync, and that can give us a good idea. I would also say that there is a lot of, we have AI now, we have huge data. It doesn't mean we are making high quality decisions in the commodity markets. And my view is that there is recycling, and AI is going to increase the recycling of insights, recycling of data. So I would put a huge emphasis on the original thinking by connecting the dots across commodities, across crude, across products. So that's the goal in my mind that we should focus a lot more on. Now, a lot of organizations are sort of compensating the competency of the talent. I feel that that's not being addressed enough by putting systems. And I will say a system is only as good as the analyst. So I think the compensating the competency of the talent by putting a good system, I have found sort of does not work. There is also a challenge which I have observed in my experience where somebody has to do the analysis and the other person has to check the analysis. And how do you check the analysis with speed to filter the key point versus noise? So the review sort of competency is a very different kind of a competency, which also I find lacking and needs to be strengthened. Now, I would say that there is a lot of debate and dichotomy between what's a market analyst, what's a data analyst. The data analyst doesn't care about what the numbers are. The market analysts are more focused on just the market side. I believe this is leading to some suboptimal insights because the learning happens, in my experience, when we do the iterations. So I would say that all the market analysts need to become very good data analysts, and all data analysts need to start feel for the numbers. Otherwise, sometimes out of proportion data gets sort of shared. Multi-dimensions versus one dimension. I think this is where I sometimes feel that you need to really look at multiple angles of the market, multiple angles of analysis, and then come up with what's really the most important versus first order, second order, third order. So the order thinking is one key challenge which needs to be addressed. And yes, there is competition, there is collaboration in the commodity market. It's a very competitive field. I know from experience, everybody guards their Excel spreadsheets, and the coaching and the mentoring is not what it should be. That's one of the reasons which I got motivated and passionate about to actually launch XAnalysts to really build this competency. But competency is as good as, I would say, the last point number is that we have to track all market calls, and it's a difficult job. I tried to do in my previous life, not fully successful, but this is something I would say becoming paramount, not just an object selective. When you get it right, you beat the loudest. When you get it wrong, you sort of do not talk about it. The idea is to track all kinds of market calls and try to decipher why did you get it wrong and why did you get it right. Now, with that, let me change a little bit more gears. And I think I see opportunities is just the reverse of these. If we can tackle all these kind of challenges, these are huge opportunities. We are blessed with data. We are blessed with tools. And I would say that now is the real time to do analysis. 10 years ago, when the AI was not there, the data was not there as we have today, the modeling was not there, probably the analysis fun was less. Now we have higher opportunity to have the analysis fun. But yes, these challenges need to be taken care. And these are some of the challenges which I, with XAnalysts, aim to really take. So in very brief, my goal here is to really break the tools versus talent sort of a vicious circle and convert into a virtuous circle, so that the decision makers hear alternate views. The decision enablers, which are the analysts, are highly competent in a granular way. And there is a huge population which boosts the decisions. People in risk managers, people in sales, people in origination, people in marketing, who also need to get a good handle on market analysis. Only when all three layers in any organization are really doing a good tools and a talent sort of a combination, then I believe the market analysis can get better. I'm trying to build an innovative, what I call IACE, the energy market analysis system, a unique combination of insights, advisory, competency building, and education. Now, let's jump to some pricing challenges. And David, probably I'll move the slides and I hand over the mic to you.
Thanks, Mukesh. Hi, everyone. Pleasure to be with you today. So yeah, we've got a couple of examples here, one reflective and one more forward-looking. So if we dive into the slides and just very briefly to introduce General Index first. So if you're not familiar with us, we are operating in a space that's traditionally been dominated by price reporting agencies. So General Index is a price data provider and a benchmark administrator. We publish data on a daily basis across 13 energy sectors. So that's everything from crude oil and refined products through to many markets and sectors emerging in the energy transition space, also natural gas. We've been up and running for about 5 years, and our network base, our community spans a lot of the majors and NOCs, trading houses, consultancies, etc., and many within the financial space. We take a very technology-led approach, which I think, in keeping with the nature of the discussions today, very much focused on data. So the sources, or rather than talking about sources, we have what we call data contributors. So we have in excess of 225 data contributors worldwide who are providing information, bids, offers, deals, so transaction information related to the market. We're a relatively lean team of market experts and data analysts, data scientists, who operate what we call a methodology as code approach. So every price, and we'll dive into some of the nuances of particular indices and benchmarks shortly, come with quite a structured methodology. We want to ensure that that is applied consistently and robustly. So we use the latest technology to codify that into a platform. It helps us as part of an overall kind of highly compliance-orientated approach. What we do, so every price that we publish meets industry sector standards in terms of regulation, and we're authorized in the UK as a benchmark administrator by the Financial Conduct Authority. So enough about GX, really. We'll dive now into the first of the case studies, and I've taken, I mean, just in keeping with the theme of Russia that Mukesh started off with. So I look, one of the and he focused on diesel, and one of the key threads in refined products markets over the last couple of years has been quite a fundamental shift, rebalancing in trade flows around diesel, and Europe has been the sort of the epicenter of this change. From a benchmark perspective, one of the most important and long-standing price benchmarks globally is a diesel benchmark. So ULSD, ultra low sulfur diesel, on a CIF basis, focused around Northwest Europe on the cargo market. Now, historically, this benchmark evolved around 30 ports in the region, and part of the the kind of premise of any benchmark is that supply has to be merchantable, fungible to all the ports that are active within that. So a vessel can't. What it means in practice is that deliveries, even into larger ports, must be transferable into smaller ports. The premise of the operation of the benchmark is that there is optimization built into it. Now, over time, these benchmark parameters had evolved very closely with the growing Russian export market, and so this was typically 30 to 40 KT cargoes delivered on MR or general purpose vessels. If obviously from 2022 we saw with sanctions, with Western sanctions on Russian oil, this flow effectively dried up, not quite overnight, but the data that we'll see as we look at some of the trade flows was very much an abrupt shift from 2022 to 2023. And so in terms of the underlying data, the trade flows, so that's been Russian volumes being replaced by volumes coming from the United States, from the Mideast Gulf, and from India. What we also see as well is changes in the vessel composition. So a decline in deliveries on the smaller MR, so MR1s, and an increase in deliveries on MR2s and LR2s. Now, if we think about some of those earlier bullet points, one of the problems, so for the diesel market and for the diesel benchmark, it's reflective of quite a lot of smaller ports that are just not designed to be able to take these larger vessels that are now increasingly coming. So if the trade flow means in practice what you see in traders bringing in the bigger vessels into the larger ports, breaking bulk cargoes in ARA, for example, and then distributing those small cargoes. Now, what that means in practice is that there's two perennial challenges really for pricing and for price benchmarking. One of those is transparency, and how much visibility do we have on what's actually going on? And then the other is liquidity. And what we've seen with this transition from Russian oil to increasing volumes from other origins was that liquidity declined on a CIF basis in terms of the transparent price discovery space, and you've seen an emergence of liquidity instead intra-regionally on a FOB basis. So from a pricing perspective, we have to kind of remain nimble and reactive to to those emerging trends and price accordingly. If we move on, I guess the next slide just sort of visualizes some of that shift in terms of the transition by origin. You can see roughly sort of midway on this chart, and so actually the sanctions, it was effectively overnight from the 1st of January 2023. Russian fuel was excluded. You could see the blue, navy blue at the bottom effectively stopped, and what you've had then is that growth in arrivals from other origins. Let's move on to our second example, which is perhaps one that sort of we'll look a bit further ahead, and aviation fuel. So in terms of the kind of supply base, it's been very homogenized, right? For over 100 years, aviation fuel, kerosene, comes from a single source, from a fossil fuel source, from crude oil derived, is crude oil derived. Some minor examples of GTL, jet fuel, that Qatar produces and elsewhere, but overwhelmingly fossil fuel. But what we need to now have in the back of our mind is that the supply base for aviation fuel is really set for radical change over the next 20 to 25 years. We've grown accustomed to thinking of a transition on road fuels, of gasoline demand peaking, of road fuel diesel demand peaking. I think we now have to think about what the transition for aviation fuel means. as the sector looks to decarbonize, it's looking to non-fossil fuel, to renewable fuel sources, so SAF produced from feedstocks such as used cooking oil, but then also increasingly kind of like sort of what are called sort of synthetic fuels or advanced generation SAFs, sort of things like power to liquids and alcohol to jet as well. Very far in the distance, you can see it is much more where, and it's very in terms of the kind of all of these types of fuels are designed as drop-in fuels, so they're sort of chemistry-wise, it's sort of a like-for-like replacement in the fuel distribution chain. So if we move ahead, just some thoughts in terms of what that might mean as we think it from a pricing basis. Again, I picked Northwest Europe. I'm biased because that's my patch, that's my backyard here in the UK. But it's also key. It's also a sort of a bellwether of what's going on internationally in trade flow markets, because it's so very much now dependent on imports. And this particular jet fuel price benchmark is reflective of that, of deliveries again into Northwest Europe. This time, I think things for us to consider pre-SAF, or the kind of the fossil fuel driven aviation fuel era, is dominated in Europe by imports, led by Kuwait out of the Mideast Gulf, but also substantial volumes that come from India and also from Far East Asia. Now, if we're thinking ahead into the SAF era, and this is why I say there's a transition underway, because and perhaps some of you are aware of this, that effective the 1st of January this year, the EU and UK aviation fuel suppliers have been mandated by regulation to blend 2% SAF into the pool. That will rise to 6% and 10% respectively by the end of the decade. So these are not insubstantial quantities. These are volumes which are being met currently by supply locally, but also increasingly dominated by production from China. And so as we look ahead, I think sort of if you're a producer in the Mideast, a very key jet fuel supplier, you need to be thinking to avoid losing market share. How can I get into it, get a piece of this action? And co-processing at existing oil refineries can be one of those ways. All of these are different elements that we need to capture in terms of pricing dynamics as well as the underlying data. Thanks, Mukesh.
Okay. Well, I think the key point, and do you want to talk about this slide quickly or done?
I think we're done. Yeah, it's sort of covered on.
Yeah. Well, thanks, Dave. I think the whole idea for this kind of a webinar in a short time is to just highlight that the typical challenges which we might face might be very external challenges, volatility. You can't do much about volatility as analysts, right? So the real deal, in my view, is to go away from all those kind of noise and external challenges and really focus on the real challenges and then work one by one. So if this particular slide stimulates some sort of a thinking, I would say I want to end in another 2 minutes or so, and then maybe leave room for 1 or 2 questions, is that each of these challenges is actually the opportunity. And the oil market analysis or energy markets analysis, in my view, is like analyzing a moving target. And the whole idea of bringing GX and David's analysis into this call was that while we are trying to make a call on the diesel cracks or diesel prices, the diesel benchmarks or pricing itself is undergoing quite a lot of change because some structural shifts happening in the market. So on one hand, we are trying to make a call on some price benchmarks, their differentials, their time spreads, while the benchmark itself is undergoing quite a change. So the analysis is like shooting a moving target. And for that, the only way I have come across from my experience working with a lot of young analysts and talented people is that the point number 5 on this slide, which is we have to really dig deeper and come and think about from an original thinking. And my definition of original thinking is that the idea, the thought has to be born in your head first. And that is something you have not read from others. So the less we recycle and we become conscious about, are we presenting or talking something which I read, which is good? You can always amplify and add on, but really emphasizing the original thinking. And that's the whole idea around building competencies and providing some sort of a different market analysis. So with that, I'm not sure, was there any questions? I do know, David, there was a question around from someone which I got on an email, which was around the dollar fluctuations and how those dollar fluctuations are impacting the prices.
Yes, I have received a question. The question is, how do you decide when an observation is noise or when the observation is more something structural?
Well, I think, thanks, Shreya, and David, you come to that question which I just asked. The key point in my mind is go back and connect the data across crude, across products. If we only look at these days gasoline analysis or diesel analysis, and we don't look at what's happening in the LNG, what's happening in the electron side of the market, that's where we can filter the noise, because numbers will not add up, right? And it's only by adding numbers in different sides rather than just looking one side of the market. That's the only antidote for filtering the noise in my experience. Thank you, Shreya. David, you want to respond to that dollar question? How to handle the dollar fluctuations in pricing?
Yeah, it's a good one. I'll give a very honest answer. In practice, from a price benchmarking basis, it's not one that we think about too often. It doesn't feel like one that has a strong like day-to-day impact, because we're very much looking at what's where there are bids, where there are offers, where there are transactions happening. And so perhaps I'll take this question away and do some analysis, and we can follow up after.
Sounds good. Well, thanks, David.
Empowering analysts, transforming markets.